This is Dr. Patrick Burnett. This quick video lecture will go over Chapter 9, which talks about the balance sheet. Now, since most of you aren't going to be accountants or CFOs, we'll keep this high level. A few of the common phrases you'll hear, these are kind of different ways of looking at the same information. There's the balance sheet, which we'll talk about shortly, the income statement, which we'll see in another chapter, and then the cash flow statement, which kind of looks at money in and money out. The reason that these two are different is that while income statements or operating statements can look at paper money, like loans back and forth, or for example, when I bill a procedure, I recognize it as an asset, whereas in cash flow, it doesn't count until I actually get the money in my hands. Now, keeping an eye on some of the questions you'll have in the assignment, or your GAAP or GAAP is just your generally accepted accounting principles, which are essentially the same as practice protocols and specialties. It's just the rules and the procedures that accountants have to use when preparing financial statements. Another term that you'll use or hear frequently is this accrual concept, which recognizes revenues or expenses when they are recorded as, let's say, earned or incurred, in the case of expenses. And I'll give you an example. Now, the opposite of accrual accounting is cash accounting, which just looks at money in and money out. Now, cash accounting, if at the end of the year you knew that there were patients who were hospitalized in that last week of the year, but you hadn't received the bill yet, if you were doing cash accounting, you wouldn't see those as expenses. But if you're doing accrual accounting, you do have to recognize those as expenses. One of the other terms you'll hear frequently is IBNR, incurred but not reported. Now, the first time I heard this, I was working with a CFO, and he was talking about these accruals right there at the end of the year, and he was talking about these things which were incurred but not reported. And what he was describing was that feeling that we knew that there were emergency room visits, there were hospitalizations that had started. In other words, and we were an insurance company, so we knew we were going to owe money on those things. In other words, those things had been incurred. The minute one of our members steps in an emergency room, we owe that emergency room money. So the expense has been incurred, but, right there, the B, it hasn't been reported yet because, well, maybe it's the end of the year, they're just doing their things, the bill won't come out for a few days, so it hasn't been reported, but we, as an insurance company, have to recognize those IBNRs. In other words, we have to recognize the fact that there are debts in the pipeline that we know we owe, but we just haven't heard of yet. Now, one of the easiest ways to think of the balance sheet is I use the mortgage concept itself. Your assets is going to equal your liabilities and your assets, or these net assets are also known as your owner's equity. Now, that equity expression makes more sense. That's a bad E. That equity expression makes more sense when you think of your house. So your asset is the total street value. That's how much you could sell it for today. That's your house's value today. Your liabilities is what your mortgage is right there. So that's what you owe. This is what your house is worth. This is what you owe on it. And that's where the equity concept comes in. Equity just means how much of your own house do you owe. In other words, how much is not owned by the bank. So that's the difference right there. And really, when you look at your balance sheets, it's the identical concepts. For the company, it's stuff that their total value, their total street value, if they were to sell themselves to somebody else, that's your assets. Liabilities is how much you owe to other people. In other words, have you taken out loans to buy all this equipment? You show a bunch of equipment here, but have you taken loans out to get that equipment? And then this net asset or the equity is anything that you actually own free and clear. In other words, some of this stuff, hopefully, you own free and clear. So that's the equity portion over here. So I'm just giving you some other little hints because, as I said, you're not expected to be accountants in the future. Now, one of the ways to read balance sheets is both for the assets and for the liabilities. They're generally listed from top down in order of, they call it declining liquidity. So in cash terms, that means actual cash or your checking account right there. Marketable securities like T-bills, accounts receivable. So you can see cash, or money in your checking account. That's money I can use today, and I don't lose any value by just writing a check. Marketable securities, I can turn that into cash pretty fast, but I might pay a penalty if I have to convert it to cash right away. I have to sell it right away instead of waiting for a good price after a day or two. And your accounts receivable, now you start to get you have to wait a little bit more for that. And that wait is another way of saying it's not as liquid. In other words, it doesn't flow as easily. For me to get my money out of accounts receivable, I can sell my accounts receivable to somebody else, and I can sell it to them tomorrow or even today for some fast cash. But the faster I have to sell it, the less they're going to give me on every dollar. So if I negotiate and find a good buyer, they might be willing to pay, let's say, 80 cents on the dollar. But if I have to sell it today, I might only get 60 cents. So that's a way of saying my accounts receivable is an asset, but it's not as liquid as cash. And it goes down from there. And the same is true for on the liability side, where they're listed in terms of more or less how soon you have to pay them. Now, I'm not going to dwell on the balance sheet, but I'll use the house analogy again to just kind of help solidify it. So on the asset side over here, the asset side is your house. It's everything in your house. It's the value of the house. It's the stuff, the new roof you put on it. It's the new doors. It's all the stuff you put on your house. This is how much you could sell your house for right there. This top part here, this is what you owe the bank. That goes to the bank. So any difference between what the house is worth and what it owes to the bank, which would be this little bit down here, that's what they call the owner's equity, or also called net assets. Basically, that's the part of the house that you own free and clear. So that's just another way to visualize when you're looking at balance sheets, what's where. This is your street value of the house. This is what you owe the bank. This is what you own free and clear. In other words, it's not owned by the bank. I'll give you just a few more terms, then we'll look at the assignment problems. Now, net book value just means recognizing the fact that assets aren't worth what we paid for them. Here, in this case, we had our van, we paid $30,000. But each year it depreciates. It's just like when you buy a car, its value goes down the minute you drive it off the lot. The same is true with any other thing. So we bought it for $30,000, but over time, let's say we're depreciating or we're writing off $5,000 a year. So after 2 years, it's worth, the 30,000 minus 5 and then minus 5 again for each year. So that's just that 20,000 right there. See it? That 20,000 would be what they call the net book value. Now, one of the other questions in your assignment is when can you, under what circumstances do you recognize an asset? It has to be owned. In other words, it has to be ours. It has to have some value, and somebody else. It has to be an objective value. In other words, somebody else has to say, yes, that's worth something. And more specifically, they have to agree that it's worth what we say it's worth.